Did you know that the average American could save over $3,000 in taxes every year just by changing how they give to charity? Most people are literally throwing money away because they don't understand the tax code's hidden charitable giving secrets. What if I told you that billionaires use these exact same strategies to give away millions while actually reducing their tax burden? Today, I'm going to reveal 10.8 powerful tax-efficient charitable giving strategies that will maximize both your impact and your savings. Before we dive deep into these game-changing strategies, let me share something that might shock you. Last year, Americans gave over $470 billion to charity, but studies show that roughly 60% of donors missed out on significant tax benefits simply because they didn't know these strategies existed. That's literally billions of dollars in missed savings that could have been redirected toward even more charitable giving. Here's the thing about charitable giving and taxes that most financial advisors won't tell you up front. The tax code isn't just designed to collect revenue, it's specifically structured to incentivize certain behaviors that benefit society. Charitable giving is one of those behaviors, which means the government actually wants to reward you for being generous. But here's where it gets interesting. The rewards are only available to those who understand how to play the game correctly. Let's start with strategy number 1, and this is absolutely foundational. Bunch your charitable deductions. Most people give the same amount to charity every year, but this approach leaves massive tax savings on the table. Instead of giving $5,000 annually for 4 years, consider giving $20,000 in 1 year and $0 in the other 3. This technique, called bunching, can push you over the standard deduction threshold in the giving year, unlocking itemized deductions that would otherwise be wasted. Strategy number 2 involves donor-advised funds, and this is where things get really exciting. Think of a donor-advised fund as your personal charitable investment account. You contribute money, get an immediate tax deduction, then invest those funds to grow tax-free while you decide which charities to support over time. The beauty here is timing control. You can make a large contribution in a high-income year for maximum tax benefit, then distribute smaller amounts to charities over several years. Now here's strategy number 3 that sophisticated donors swear by. Donate appreciated securities instead of cash. When you've held stocks, bonds, or mutual funds for more than a year and they've increased in value, donating them directly to charity creates a double tax benefit. You avoid paying capital gains taxes on the appreciation, and you still get to deduct the full fair market value as a charitable contribution. This strategy alone can save wealthy individuals tens of thousands of dollars annually. Strategy number 4 is perfect for anyone over 70.5 years old. Qualified charitable distributions from your traditional IRA can satisfy your required minimum distribution while excluding that income from your taxable income entirely. This is particularly powerful because it doesn't require itemizing deductions and can help keep you in lower tax brackets while supporting causes you care about. Let's talk about strategy number 5, which involves charitable remainder trusts. This advanced technique allows you to donate assets to a trust, receive regular income payments for life, claim an immediate tax deduction, and ultimately benefit your chosen charity. It's particularly effective for highly appreciated assets like real estate or large stock positions. The complexity requires professional guidance, but the tax benefits can be extraordinary. Strategy number 6 focuses on timing your charitable giving around major financial events. Selling a business, exercising stock options, or having an unusually high income year creates opportunities to maximize charitable deductions when they provide the most tax benefit. Smart donors plan their giving strategies around these events rather than giving randomly throughout the year. Here's strategy number 7 that many people overlook entirely. Charitable gift annuities provide guaranteed income for life while supporting your favorite charity. You transfer cash or property to a qualified charity in exchange for fixed annual payments and an immediate tax deduction. This strategy works particularly well for retirees seeking predictable income streams while maintaining their charitable giving goals. Strategy number 8 involves establishing a private foundation, which makes sense for individuals planning to give away substantial amounts over time. While there are minimum distribution requirements and administrative complexities, private foundations offer maximum control over charitable giving decisions and can provide tax benefits across multiple generations of a family. Now we're getting into advanced territory with strategy number 9. Charitable lead trusts work opposite to remainder trusts by providing income to charities for a specified period, after which remaining assets pass to your beneficiaries. This technique can dramatically reduce gift and estate taxes while supporting charitable causes, making it particularly attractive for wealthy families focused on wealth transfer planning. Strategy number 10 involves pooled income funds, which combine contributions from multiple donors into investment portfolios managed by charitable organizations. Contributors receive variable income based on fund performance and immediate tax deductions based on their remainder interest. This approach provides diversification and professional management while supporting charitable goals. But here's the critical insight that ties everything together. The most tax-efficient charitable giving isn't just about following these strategies individually. It's about combining them strategically based on your specific financial situation. A comprehensive approach might involve bunching contributions into donor-advised funds during high-income years, donating appreciated securities when capital gains are substantial, and using qualified charitable distributions during retirement. The documentation requirements for these strategies cannot be ignored. The IRS requires specific forms and substantiation for various types of charitable contributions. Cash contributions over $250 require written acknowledgement from the charity. Non-cash contributions over $500 require Form 8283. Property valued over $5,000 typically requires qualified appraisals. Failure to meet these documentation requirements can result in complete denial of charitable deductions. Here's something most people don't realize about the current tax environment. Recent tax law changes have temporarily increased the charitable deduction limits, allowing cash contributions of up to 100% of adjusted gross income in certain circumstances. These enhanced limits won't last forever, making current tax years particularly attractive for implementing aggressive charitable giving strategies. The psychological aspect of tax-efficient charitable giving deserves attention too. When people realize they can give more to charity while paying less in taxes, it creates a positive feedback loop that often leads to increased overall charitable engagement. Many donors discover that strategic giving allows them to support causes they previously thought they couldn't afford to help significantly. Risk management remains crucial when implementing these strategies. Market volatility can affect the timing of appreciated asset donations. Charity financial stability should be verified before making large contributions. Professional guidance becomes essential as strategies increase in complexity and contribution amounts grow substantially. Looking ahead, tax law changes continue to affect charitable giving strategies. Estate tax exemption amounts, income tax rates, and specific charitable deduction rules evolve regularly. Staying informed about these changes ensures your charitable giving strategies remain optimized for current tax law, while supporting your philanthropic goals effectively. The bottom line is this: tax-efficient charitable giving isn't about finding loopholes or avoiding taxes inappropriately. It's about understanding how the tax code encourages charitable behavior and structuring your giving to maximize both your impact and your tax benefits. When done correctly, these strategies create win-win situations where you support causes you care about while keeping more money in your pocket to give again next year. Start by evaluating your current charitable giving approach against these 10 strategies. Identify which techniques align with your financial situation and philanthropic goals. Consider consulting with tax professionals who specialize in charitable planning to ensure proper implementation. Remember, the goal isn't just saving taxes. It's creating sustainable giving strategies that maximize your positive impact on the world while optimizing your financial position.